as if being an economist wasn't nerdy enough, I guess. I had to be a little nerdier with the Marvel stuff. So anyways, I'm going to go through very quickly. I'm glad that Greg gave me 3 hours to talk this morning, right, for your birthday. So yeah, you'll see lots of slides up here. I'm only going to go through a few of them because I want to get to Q&A as quickly as I can, given the limited time. And I don't know why I'm looking there, because I'm over there. Let's go through some quick little updates about what I'm seeing in the economy. And then in the Q&A, we can get to energy and politics and the Fed and whatever else you want to talk about. Excuse me. So the first thing, I always like to start with this chart because for those of you who've seen me before, this really gives you the sentiment of what manufacturers are thinking. And so, and also, I think in many ways, it summarizes really where manufacturing has been over the last year and a half or so. So this is the ISM Purchasing Managers Index from January of last year to April of this year. For those of you who don't look at this data on a regular basis like I do, numbers over 50 are expansion, numbers under 50 are contraction. We've been expanding throughout all of the last 16 months, so that's the good news. But you see up here quite a bit of volatility, lots of lines. I'm in particular going to be looking at the dark blue, which is new orders, and the orange, which is production. So last year at this time, I felt like a meteorologist. I was talking about the weather so much. If you remember last year, the beginning of 2014, we actually had a contraction in the US economy, a negative 2.1% decline in GDP. Lots of discussion about the weather and how that really messed things up at the beginning of last year. But by the middle of the last year, things were really hitting on all cylinders. So if you look at the second half of last year, lots of traction. Demand was up, production was up, and you see that in the two lines that I pointed out to you a second ago. Both of those measures were not just over 50, but they were over 60 for either 5 or 6 months at the end of last year. So the second half of 2014, a lot of strength in the economy, and because of that, we came into 2015 with a lot of momentum. People were expecting that 2015 would finally be the year that we would get some traction in the US economy. In fact, the forecast for this year coming into it was 3% growth in GDP, and everyone was finally excited, right? Well, as you can see by this graph, it hasn't quite worked out that way. And so you see that all of the lines really have eased pretty significantly, really from December on. And so what's behind that? Well, there are a number of challenges in the US economy, really the global economy, that really have confronted manufacturers so far this year. The first to mention is the dollar, and I'll show you a chart on the dollar in a second. But we've seen, I've been doing a lot of traveling recently. Almost every meeting I talk to with manufacturers, the dollar comes up in some way, and you'll see that in a second. So I'll save that conversation when I show you that graph. The second is the global economy in general. You're seeing slowness in China, Europe. I was laughing this morning, for those of you who are looking at the Wall Street Journal. The Wall Street Journal said that Europe has grew the fastest in 2 years, and I'm like, wait a minute, I just saw that report yesterday. Why are they making such a big deal of this? Europe grew 0.4%, 0.4%. And for those of you who get my Monday report, you also get my global report. It's coming out today. When I first read that headline, I'm like, well, maybe I missed a number there. It was sounding so upbeat that, anyway, they're pretty happy over 0.4%. Obviously, Canada is struggling right now with lower energy prices. Mexico is growing, but not quite as fast as we would like. South America is a mess. You kind of look around the world, and it's very difficult to see where export growth is really kind of growing at a rapid pace. In the US, we've had lower crude oil prices. Certainly that's, I'm sure, something that's come up at this conference. And the impact that's had not just in Canada, but in Texas and really that whole energy region of the US. You're seeing production down. You're seeing the supply chain really in the manufacturing sector hurting from that. And so that's a pretty major headwind. The West Coast ports issue, even though that was settled more or less a couple months ago, I continue to hear conversations from manufacturers about how logistically that continues to be a challenge for them. Weather, again, particularly in the Northeast, was an issue this year. And then the last challenge that I'll kind of throw out there, we got retail sales numbers yesterday, for those of you who weren't looking at the news, and they were unchanged. So you still have this very cautious consumer out there, even though we have gasoline prices where they are and people are supposed to be feeling a little richer because of that, you still have that cautious consumer. And so as a result of all of that, you have the graph that I just showed you. You have a much more sluggish growth in the US economy than we would like. And so let's get to GDP. So you saw the GDP numbers that came out, I think a week or so ago, for the first quarter were 0.2%. Now the consensus estimate going into that figure was that we were going to have roughly 1% growth in the first quarter. So this was certainly a disappointing number in that regard. Look for this number to get revised lower in the next few weeks as we've gotten more data in, particularly on the trade side. This number could probably shift slightly into negative territory. In general, though, if you look at the last few quarters, notice that we had very strong growth in the second and third quarters of last year, the strongest 2 quarters back-to-back we've had in a long time. And you go back to what I said earlier. In general, the second half of last year was really, really robust. And in fact, even in that fourth quarter where we had 2.2% growth, if you were to just look at business spending and consumer spending in those 2 quarters, we would have had 3.6% growth in the fourth quarter. The real drag in the fourth quarter was net exports and government, but we're used to government being a bit of a drag, right? So the real story there is net exports. And so you've really seen over the last couple quarters, those dollar headwinds that I mentioned a second ago are significant. In fact, net exports in the last quarter, the first quarter that I just talked about, subtracted 1.25 percentage points from GDP. So if it hadn't been for those huge dollar headwinds, that huge global headwind hitting the U.S., we would have had a little bit better numbers for the first quarter. Now I have 3.3% growth up here for the quarter that we're currently in. That number might come down a little bit. I'm still optimistic that we'll have a little bit of a rebound, particularly if we move into negative territory in the first quarter, have a little bit of a rebound in the second quarter. And part of why I still have relatively decent numbers in this chart is that when you talk to manufacturers, now that I've depressed you, right? When you talk to manufacturers about the next 6 months or the next 12 months, in general, they tend to be relatively upbeat. I know at the reception last night when I was talking to everyone, that's the first question I ask as an economist. How is it going? How's your business? So what's demand like? What's production like? And many of you are relatively upbeat. And so even in light of many of the current challenges that we have, there's an expectation that production and sales are going to be stronger down the line. You also see, I met with Gray Construction yesterday, actually. They also were very upbeat about, you're seeing a huge increase in construction spending over the next, certainly companies are making huge investments in terms of plant and equipment, also in terms of hiring. The hiring data, while we've had some weaker data lately, has been generally positive for the manufacturing sector. So still you have that level of optimism that's out there. So we do a survey that we do quarterly. For those of you who are NAM members, you're going to get an email from me tomorrow saying, please fill out the next quarterly survey. So just as a little commercial there. But in the last one, so this was in February, it came out in March, 88.5% of our members were upbeat. So you still have that kind of a strange nuance of, well, look at all these challenges in the current environment, and yet when you talk to manufacturers about their own company's current outlook, it tends to be relatively upbeat. I wouldn't be shocked to see that number fall a little bit, but still be relatively positive in the next survey that we get. So I'm going to just do a quick little conversation about the global economy, since I think that was the headline, right? Don't worry, I will not go through all 10 of these countries. But this shows you, as I mentioned today, the Global Manufacturing Economic Update is coming out, and you're seeing way too much red on this chart. These are the top 10 markets for U.S. manufactured goods in order. So, Canada, Mexico, China, Japan, the UK are the top 5. You have 6 of the top 10 which are currently contracting, so they are red up here. This shows you the headwinds that we're seeing in the international market. I could go through each one of them in detail if you want me to, but I won't, just to save time. In general, you're seeing that the global environment, the global economy is not doing as well as we would like. Europe, since I made a comment about Europe earlier, the 0.4% rate, we are seeing slightly better data coming out of Europe, but you have to keep it in perspective there a little bit. Here's the dollar chart. Now this is the dollar chart as of last week. Today, if you're following the markets, you'll see that the dollar is weakening a little bit, and so this number will get a little bit better. But in general, the dollar has strengthened really since last June. We've seen some pretty steep increases in the dollar. At one point, a few weeks ago, the dollar had strengthened 22% against major currencies around the world. Today, it's roughly 16%. So, it's better than it was a few weeks ago, but that's still a pretty significant headwind. If you're a U.S. manufacturer competing against a Canadian manufacturer or a European manufacturer or whoever it is, and you're having to report your earnings, obviously in dollars, or you're having to compete in an environment where your costs have suddenly shot up, this is a pretty significant headwind for many manufacturers. As I said, I've met with some manufacturers over the last few weeks. One of them I know did 60% of their business overseas, and they're worried about how are you going to be able to compete in an environment like that. Now, what's moved this dollar down a little bit, just to kind of show you that decline from 22% to 16%, is that as I just said, the European economy is doing a little better than people thought, and the U.S. economy is doing a little worse than people thought. And so that's moving the dollar flexibility a little bit along those lines. And a large part of this conversation is a conversation about what the Fed is doing or not doing, or what people think the Fed's going to do or not do. And going into the last month or so, there was a kind of a conventional wisdom that the Fed was going to start raising short-term rates in June, or at least as soon as June. And I think the conventional wisdom now has shifted to it probably won't act in June, but will probably act in September. And you have some folks on the Fed who are saying, why are we acting in September at all? Let's just push it to next year. And so that's really what's moving this conversation with the dollar, is when will the Fed start raising rates? At the same time, the European Central Bank is spending €1 trillion over the next 18 months to prop up the European economy. So while they are becoming more stimulative, we're raising rates. And so that's what's really moving the dollar a little bit along those lines. And so this is certainly a number to watch, and what's moving a little bit of the market lately. I'll do a couple more slides here, and then we'll get to Q&A. So the first one is the employment market. So on the employment sector, you see that the last couple months we've had relative sluggishness in terms of overall employment growth. I'm going to put a glass half full picture on this one a little bit. So looking just at the red bars, yes, we've had some weakness the last 3 months in terms of hiring, and that really gets to those challenges I talked about earlier. But over the last 16 months, manufacturers have added 14,500 workers per month. 14,500 workers per month. That's a relatively decent pace. We certainly would like to return to that, and I think that we will return to that pace of employment growth in the coming months. Once we kind of move past the current funk that we're in terms of some of these challenges that I just mentioned earlier, I think we will return to that stronger growth on the employment side. And just to kind of put that in perspective, that 15,000-ish number, if we were to add that number every month for the next few years, you often hear conversation about manufacturers adding 1 million workers between now and 2020. It would take that roughly 15,000 to 17,000 workers per month to get to there. So it's a relatively strong figure overall, and certainly one that we'll return to. In terms of the blue bars, so that's non-farm payrolls. In 13 of the past 14 months, we've seen non-farm payroll growth of 200,000 or more. And so yes, we had a fairly weak March number, but we saw a rebound in April, and that's kind of what I'm expecting to see on the manufacturing side as well. And I think I hit the wrong button. There we go, I got it, thank you. So the unemployment rate is 5.4%. Look for that number to get to be 5.1, 5.2% by the end of the year. Now I'm going to put a little bit of an asterisk next to that, though, because when I was studying economics back in the late 80s, early 90s, 5.1 was a good number. I might have even considered 5.1 to be full employment, kind of what that means. But the reality is, I think, given the current environment, it's kind of hard to say that 5.1, if we were able to get that this year, would be considered full employment. I think that the reality is, given a lot of part-time employment, underemployment, participation rate being where it is, that I think you're still seeing some slack in the overall economy. I'm going to do one more chart here, just to show a couple more charts on the employment before I get to a quick question, I guess. These are the sectors that are growing right now in terms of over the last 16 months. You see transportation equipment up there, so that's motor vehicles and aerospace, but you see a lot of other things up there. A couple things to kind of point out, particularly since ACC, the American Chemistry Council, is right after me. You see that chemicals is positive, so chemicals have added 16,200 workers over the last 16 months. You can insert the words shale and lower cost energy for why the chemical sector is doing so well. We're seeing a lot of investment in that space, and it continues to be kind of a large part of why we're having a renaissance in manufacturing. I'll show you the next one because Kentucky is in the top 20 here in terms of where we've seen manufacturing job growth. You see Kentucky has added 5,500 workers over the last 16 months, so that's obviously a nice positive. So I think I have 3 minutes left, so I'm going to go straight to this last slide, which I went too far. And what questions do I have? I think I have time for maybe 1 or 2 questions. That's it at most. So what questions do I have out there in the audience? Everyone is quiet. No questions. Yeah. Well, I think, so I mentioned obviously the dollar and I think energy. Certainly those are things to worry about. You know, what I have been telling folks with regard to the dollar and some of these other issues is that certainly affects our overall global competitiveness. And I think if anything, what we need to do is we need to focus a lot more on what we can do to make Kentucky and the U.S. more competitive on a global scale. And so this really, I think, begs the issue of doing comprehensive tax reform. We desperately need tax reform to make us more competitive on a global scale. So you're seeing some rumblings about some corporate tax reform this year, probably to pay for infrastructure investment. From the NAM's point of view, we would like to see that as more comprehensive. You know, most of our members are small and medium-sized members, and so you can't really do something on the corporate side without doing something for pass-throughs as well. So I think that's the first thing. The second thing, and Mitch McConnell mentioned it earlier, we've got to do something to restrain the regulatory burdens in this country. And from our perspective at the federal level, we're doing everything we can do to make bad rules less bad through the comment process. But at the end of the day, many of those rules are going to get promulgated, and we need to fight them in the courts. We're doing a very aggressive pushback in terms of suing. In terms of suing some of those agencies to try to push back against some bad regulations. And so the basic gist of what I'm saying is we've got to do everything we can to make the U.S. more attractive and Kentucky more attractive from a business point of view. So I have one more question, I think. Yeah.
Okay. While I'm walking that way in response to Lynn's question, 2 things from Cam's perspective. How does the energy issue and the education workforce issue compare in other states? We are struggling with that.
Yeah.
Good. I always love charts and data. The last chart you put up was the number of the increase in manufacturing jobs.
Yes.
In absolute number. Have you done any per capita analysis of that? Because Kentucky is a relatively small state, and it would move it around significantly for us.
And you're right. Kentucky does fares better if I were to put that up as a percentage basis. I can get that to you guys as well, just to show you that. I think Indiana does well. A lot of states which are, particularly in this area, do well when you look at it on a per capita basis. And just to throw out your question on skills gap.
Chad, if you could, that's right now, those are the 2 biggest challenges in Kentucky, our energy cost and finding career-oriented workers to go into our workplace.
So I kind of skipped over that chart earlier, but when I talk to members and you get away from the economic issues, I think the one other issue that's kind of universal across the board is that manufacturers are struggling to find talent. And I think that one of the things that we really have been pushing pretty aggressively at the federal level and in working with our state partners like CAM is making sure that more young people go into manufacturing, changing perceptions about what manufacturing is. I know you had 3 tours yesterday. We tried to push a lot of that to kind of change people's minds about what a manufacturing environment is like. We have Manufacturing Day coming up again in October. But anything we can do to make sure we're proactive in terms of putting out skill sets and working with educational institutions to make sure they offer programs that are career to work. Changing perceptions about manufacturing. Will we do a Got Milk kind of campaign for manufacturing? That's something we certainly have talked about doing as much as we can. But we need to be able to make sure that we can address those skill shortages because, when you look again across the board, almost every manufacturer, small, medium, and large, and almost every sector is saying, where is that next generation of welders, mechanics, engineers, et cetera, going to come from? And so luckily, we're proactive about it, and many of our members are doing quite a bit on that front, especially CAM, and we're happy to see that, but a lot still has to be done. And I think my time up, I have... Well, I think that we need to look at alternative energies. I think the challenge with alternative energies is that you can't just flip a switch. That I think when you look at over the last few years, coal still plays an important role in our economy, and I think that there are a lot of folks in Washington who would like to flip the switch on coal. And that's not going to happen. I think coal plays an important role. You can't have enough windmills, wind-powered energy. I mean, you have to put windmills pretty much across the whole country to make up for that loss. And so I think that we need to be proactive. We need to be smart about our energy policy. We at the NAM support an all-the-above energy policy, so it's not just alternative energy, but it's also, each of those plays a role in that. Nuclear plays a role in that. And we really haven't had a comprehensive discussion about what are we going to do about energy policy for a long time. And coal plays an important role in that, as well as alternative energy. And we need to make sure that we are smart about the way that we go there. And I think that many energy companies are looking at that as well. So I think that's it. So if you would like my Monday report, just give me a card and I'll make sure you get it. Thanks.